Hello friends, welcome to my class Learn Income Tax in an Easy and Simple Manner. My name is Dr.Sunjeev Batra and this is my second class about the topic penalty and prosecution. In the last class, I have told you about the main prominent sections of the penalty. I started with the prominent section of penalty that was under section 270 capital A. And I have also told you about from the assessment date 2017-18 there was a sea change in the penalty provisions and new sections were inserted by the Finance Act, and government at that time taken into account the cases where the penalty under section 270(11)(c) was deleted and other factors also. So government decided to bring new sections so that assessee as well as the department could learn about the penalty provisions in an easy and simple manner. We will see that whether we could be able to learn the penalty provisions in a simple easy manner, and also whether government brought the new provisions and it is easy for us to learn the income tax provisions about the penalty and prosecutions. We will see. Now come to the penalty provisions. The penalty, the main section I have told you, and in my last class also, that is 270 capital A. Most of the time while completing the assessment or other proceedings by the appeals or the Commission of Income Tax or the Principal Commission of Income Tax, we will find that under this section penalty generally imposed whenever there is a addition is made. I have discussed about the subsection, three subsections of section 270 capital A. The first subsection of section 270 capital A was about who can impose the penalty. There are three authorities under the provisions. First authority is assessing officer, second one is Joint Commission Appeal or Commission of Income Tax Appeals, and third authority is the Commission of Income Tax or Principal Commission of Income Tax. They can initiate and impose the penalty while completing the proceedings under the Act. The Act mandates these authorities to impose the penalty when they find that there is underreporting or misreporting of income. Second section, who is the person now question arises, who is the person who is having the underreporting of income? Under this subsection, it tells us about whenever there is a difference between the assessed income and the income determined under section 143(1)(a), and that difference is the underreporting of that person. Second clause of this tells us about that when assessee has not filed the return of income or has filed the return of income first time in response to notice under section 148, in that case the difference between the income assessed and the maximum amount not chargeable to tax shall be the underreporting of income for that person. The third one is whenever there is a reassessed income and reassessed income is greater than the assessed income, last assessed income, and the difference between these two incomes shall be the underreporting of incomes. So in all these subsections, the crux is what is underreporting of income. We can say that whenever there is a difference between in a simple manner, whenever there is a difference between the assessed income which is greater than the income determined under section 143(1)(a), where the return of income is filed, or when the return of income is not filed, assessed income is greater than the maximum amount not chargeable tax, shall be the underreported of income. And when there is a reassessment of a case and reassessed income is greater than the last assessed income, the difference between these two incomes shall be the underreporting of incomes. Now we will take up some examples so that it will be easier for you to learn, and you can see in my slides. In the second slides, I have told you that who can impose the penalty. I have told you about the authorities, and I am going to take up some examples, not wasting times again on these subsection 1, 2 and 3. And slide start. Yes, here you can see in my slide there is an example. Mr. X, who is 38 years old, has assessed income of rupees 7 lakh. Then his URI shall be rupees 4 lakh 50,000. How? How it is? As I have told you that whenever there is a case of individual and the assessee has not filed the return of income, in that case the difference between the assessed income and the maximum amount not chargeable tax shall be the underreporting of income, that is URI. In short, URI. Here 7 lakhs minus 2 lakh 50,000 is the whatever is the amount shall be the underreporting of income, that is 4 lakh 50,000, and on that amount tax is computed. You can see the tax is computed as 27,560. Now taking the next slide, in the case of company, but in the case of company, firm and local authority, there is no exemption limit. So what will happen? What will happen in that case? We shall directly take whatever assessed income is there. We will take up that income as underreported income if the no return of income has been filed by these persons, company, firm and local authority. If Mr. X Private Limited, Mr. X Private Limited is a concern and the income assessed is rupees 7 lakh, you can see in the slide illustration, and the direct tax calculated at the rate of 30%, because it is a case of domestic company and the tax rate is 30%. On that amount you can see the tax amount 2 lakh 18,400. But in case assessee has these persons have filed the return of income, what will happen then? It is started with return of income is 15 lakh, income determined under section 143(1)(a) is 22 lakhs, income assessed under section 143(3) is 30 lakhs. Now you can see what is the difference between the income assessed and the income determined under section. We are not concerned with the return of income. We are only concerned with the what is the income determined under section 143(1)(a). Income determined under section 143(1)(a) is 22 lakhs. Income assessed under section 143(3) is 30 lakhs. Differential is 8 lakhs. That is the underreporting of income. Now taking the next slide. In case of reassessed income, I have told you when there is a reassessment of the case, the difference between the reassessed income and the last assessed income shall be the underreporting of income. Now in this example, reassessed income is 36 lakhs, last assessed income is 30 lakhs. The difference is clear. It's clear. Very 6 lakhs. 6 lakhs is the underreporting of income. On that amount tax will be calculated and afterwards the penalty will be calculated. Next, taking the next example in the next slide. It is a case of loss. Whenever there is a case of loss and the loss is reduced in the assessed income while assessing the case, let us assume that there is a loss of 10 lakhs. Assessee has filed declaring the 10 lakh loss in the return of income, and the income is assessed at a loss of rupees 2 lakhs. It means that there is a difference between these two income or losses is 7 lakh. That 7 lakh is the underreporting of income, and treating that loss is total income, and on that amount tax will be calculated after. Subsequently, penalty shall also be calculated. Now we can see the example. In this case, return of loss has been filed at rupees 9 lakhs. Income determined under section 143(1)(a), 7 lakhs loss. Income assessed 5 lakhs. Now we have to calculate the difference between the assessed income and the income determined under section 143(1)(a). That amount will be the underreporting of income. In that case, the difference is only rupees 2 lakhs. So the 2 lakhs will be the underreporting of income. Now they have taken the example that income is reassessed and the amount is reassessed at rupees 4 lakh. Minus plus. Please remember it. Whenever there is a loss has been converted into income, and you have to taken the difference amount, you have to calculate the difference amount minus loss, assessed loss minus income converted shall be added, and that amount will be the underreporting of income. Now come to the example again. In that case, income reassessed is rupees 4 lakhs. That is positive income plus income, and the assessed loss is 2 lakhs. Assessed loss is income assessed is minus 5 lakhs. Now minus 5 and minus 4 both will be aggregated, and the total will become the 9 lakhs. That 9 lakhs is the underreporting of income. Tax will be calculated on that amount. After that, penalty shall be calculated on the tax amount at the rate of 50% or 200% as per the case. Now in the next slide, it is a case of firm. XYZ is a firm, and they have mentioned some particulars for the assessment year 2019-20. In this case, return of income has been furnished under section 139(1), that is at rupees 50 lakhs. Income determined under section 143(1)(a), that is 60 lakhs. Income assessed income is 143(3). Under section 143(3) is 75 lakhs, and reassessed income. So in this example, all types of income have been taken, so that you can understand what will be the underreporting of income in every circumstances, at every step. First, we will calculate the underreporting of income in the case of income assessed and the income determined under section 143(1)(a). You can see the difference between these two incomes is the 15 lakhs. So in that case, underreporting of income shall be 15 lakhs rupees. But after reassessing the income, the difference between the reassessed income and the assessed income is 20 lakhs, and 20 lakhs shall be the underreporting of income when the case of the assessee reassessed under section 147. Tax shall be calculated on that amount, and after that penalty shall be imposed at the rate of 50% or 200% as the case may be. Now you can see that tax has been calculated taking 20 lakhs plus 75 lakhs. Whenever how the tax shall be calculated, that is defined under subsection 10 of this section, that is 270 capital A. You have to, in a brief, in a nutshell, I would like to tell you that how the tax shall be calculated. You have to take the underreporting of income increased by last assessed income or income determined under section 143(1)(a). That amount, whatever amount comes after aggregating these two incomes, on that amount tax shall be calculated, and after that the tax determined under section 143(1)(a) or the tax determined under section 143(3), that amount, that tax on that amount shall be reduced from that amount, and the balance shall be the under reporting of income. This procedure has been defined under subsection 10 of this section. I again tell you that you have to take the underreporting of income. Let us assume that, start with this. Let us assume that underreporting of income is, in this example, is last assessed income in this example is 75 lakhs. 75 lakhs. You can see the income assessed. Now the difference between these two income, reassessed income and the assessed income, is 20 lakhs. You have to take 20 lakhs plus 75 last assessed income. What the provisions say? Take the underreporting of income. Underreporting of income increased by the last assessed income, that is 75 lakhs. Tax shall be calculated on that amount, and from that amount tax on assessed income shall be reduced, and the result will be underreporting of income or tax on underreporting of income. So in the next example, ABC Limited is a domestic company liable to pay tax at the rate of 30%. In this case, it is a case of AY 2019-20. In this case, return of income furnished at a loss of rupees 15 lakhs, loss determined under section 143(1)(a) 8 lakhs, assessed loss is rupees 5 lakhs, and reassessed income is 4 lakhs. Now it is visible that what is the underreporting of income at every step, because it is similar to the previous illustration. First, taking the assessed income, difference between the assessed income or loss under section 143(3) minus income determined under section 143(1)(a), that is the difference between these two losses is 3 lakhs. So underreporting at this step shall be the 3 lakhs income, and after the reassessed income, the difference between the two will be minus 5 lakhs minus 4 lakhs is equal to plus minus plus. I have told you that, and the result will be 9 lakhs. So tax shall be calculated on that amount, and you can calculate the penalty after that. We are just focusing on the subsection about the underreporting. What is the underreporting income? Not about the tax. We will discuss the step of tax while defining the provision of subsection 10. Again, we will take up these examples so that you can always remember, and it will always remain imprint in your mind while calculating the penalty under section 270 capital A. Next example, Mr. X, 34 years, has not furnished his return of income for the AY 2019-20. However, his total income assessed at rupees 14 lakhs. Compute the penalty. So in this example, it is telling us about the compute the penalty. Now we are not discussing here, I am not going to tell you about how the penalty shall be imposed, at what rate the penalty shall be imposed. Only we are going to discuss about what is the underreporting income in that case. It is clear that assessee has not filed the return of income. It is a case of individual, and the age of the assessee is less than 60 years old. So definitely the maximum amount not chargeable tax is 2,50,000, and you have to reduce that amount from the assessed income, that is 14 lakhs, and the balance amount is 11,50,000, that is the underreporting of income. Now the next example for the AY 2019-20, and it is about the company again, namely A Limited. The particulars of the income has been defined as under: total income as per return of income is 70 lakhs, income determined in section 80 lakhs, income assessed as per normal provision 143.3, 1 crore 20 lakhs, deemed total income as per return of income 1 crore 70 lakhs, deemed total income determined under section 143(1)(a) 1,85,000, deemed total income assessed 2 crores 15 lakhs. So in this example, all the facts about subsection 3 in my class, I have told you about the formula A minus B plus C minus D. What was A? A was the income as per normal provisions, income assessed as per normal provisions. B was the income assessed as per normal provision minus underreporting of income, plus C. What was C? C was the deemed total income assessed. D was the deemed total income assessed minus underreporting of income. When we aggregate to this A minus B plus C minus D, then what will be the amount shall be the underreporting of income for that assessee, for that person. Now come to the example. In this case, you can see that income assessed as per normal provision is 1 crore 20 lakhs. So as per normal provision, what will be the underreporting of income? It is clear, 40 lakhs shall be the underreporting of income. And when we come to the deemed total income determined under section 143(1)(a) 1 crore 85 lakhs, deemed total income assessed under section at rupees 2 crores 15 lakhs. The difference between these two is 30 lakhs. So 30 lakhs will be the underreporting income, and for the A Limited, the underreporting income will be 40 lakhs plus 30 lakhs, that is 70 lakhs. We will calculate the tax separately for both. After that, tax will be combined, and tax shall be calculated on that amount, and after that penalty shall be calculated. Now come to the solution. You can see the solution in the solution that I have already told you that A minus B is 40 lakhs URI, C minus is 30 lakhs, and tax has been calculated. That is how the tax is calculated: 40 lakhs underreporting income plus 80 lakhs, that is the income determined under section 143(1)(a), and the tax has been calculated on that amount, and from that amount, tax on income determined under section 143(1)(a) has been reduced. After that, tax on URI as per normal income has been computed. And what about the deemed total income? Deemed total income is 30 under deemed total income, URI is 30 lakhs, and the deemed total income determined in section 143(1)(a) is 1 crore 85 lakhs. On that amount, tax has been calculated, and tax determined on deemed total income has been reduced from that amount, and the balance is the tax on URI. Both tax shall be aggregated, added to each other, so that the total tax on URI shall be computed. After that, penalty is calculated under section 270 capital at the rate of 50%. So the illustrations end here. I have given you many illustrations so that you can understand what is underreporting of income, how to calculate the underreporting of income, and who is the authority who can impose the penalty under section 143 under section 270 capital A. Now the next subsection is 4 and 5. 4 and 5, they are interrelated to each other. Whenever we found these provisions provides that mandates that whenever there is a receipt or deposit or investment appears in any year, but the source of these receipts are or pertains to earlier year or pertains to preceding years, and it is not, and they are not, you can say that they are not concerned to only one assessment year, they are concerned to more, the source of these receipts, deposit or investment concerned to many preceding years. In that case, if the source of amount has not been added, source of amount has been added back while calculating the income in those years, but the penalty has not been imposed, in that case this provision tells us that penalty can be imposed under this section because the penalty has not been levied in the source years. We can we can go through these provisions again, so that I will tell you that what will happen when there is a receipt or deposit appears, investment appears in a year. Let us take an example. Let us assume that the deposit appears in the assessment year 2019-20. Amount is 50 lakhs. And but the source of these deposits pertains to earlier years. Let us assume that in the assessment year 2018-90, the source of these deposits was 5 lakhs. Prior to that, 17-18, 10 lakhs. Prior to that, 16-17, 5 lakhs. So that the source of these deposits pertain to preceding years, but the amount was added in that year, but the penalty was not imposed. In that case, these provision tells us that mandates that penalty can be imposed under this section in this year. But you have to take precaution that while calculating the penalty, tax shall be calculated at the year from which the assessment year pertains. Tax rate shall be applicable of that assessment years, and the penalty shall be imposed in the current assessment year. And you have to take care also that I have already told you that up to the assessment 2016-17 there was penalty provision under section, there was a penalty under section 270(11)(c), but we will not take up that penalty while calculating the source, while taking the source from the earlier years. We are not concerned with that. We are going to impose the penalty in the current year, but the source of these deposit, receipt or investment pertains to only preceding years. So only we have to tax calculate according to that assessment year. After that, penalty shall be imposed in the current year, taking 50% and taking that amount under reporting of income at the rate of 50% or 200%, whatever the case may be. So in this class, I have told you about the what is underreporting of income, who can impose the penalty, and in the where the receipt, deposits or investment appears in the current year, but the source pertains to earlier years, then we have to take up the case differently. Now I will close this class because there are another there are 6 to 12 sections or subsections are more in this section, and it will be difficult to complete in a 1 or 2 classes. So I hope that in the next class I am going to end this this provision, this penalty provision under section 270 capital A, and I would like to thank you that you are viewing my classes, and I'm also expecting that you will like my class, subscribe it, share it. I again thank you, and with this I close this session and hope to meet you in the in my next class. Thank you again.